as balls are going wild across the board. How are you doing this fine OPEX week?
Well, you see, I'm here at my fake beach house, so I'm having
I was going to tell Ernest, really, you've been crushing it lately.
If only, mate. If only. Yeah, it's interesting times for sure, right? The market went to sleep for a while. Vols went super low, as you've been talking about in quite a lot of detail, and suddenly things are coming alive again. Geopolitics is obviously at the forefront of everyone's minds. Every weekend now is a risky weekend, and these guys don't want to stop fighting right now, which is a bit precarious. But then on top of that, you throw in the inflation story, where yields have broken above key resistance levels, and they look like they're headed to 5% fast. Right, two-year yields are already back to 5%, and the long end's not too far behind.
Yeah, it's. I spent a long time in our morning note waxing poetically about longer term issues, and you just really framed them all. We had the problem of extremely low vol environment. We did a presentation about that. We still have not had a move above 2%. This is now 400 plus days. It's the third largest time in the last 20 years that we have not had a 2% drawdown. And so, to your point, vol is picking up across assets. We could show a chart on that. Rates uncertainty, global political uncertainty, geopolitical uncertainty. And yeah, VIX is 19, but we're not puking here, right? And that's, I think, what is so interesting about the current situation and environment. So bring up a couple charts and talk about that. So first, let's set the stage here just in terms of that rate volatility. This is a presentation we just did on the OPEX effect. If you want to check that out, you can go over to excess returns. But the chart I want to show here, and it's a little hard to view, I'm sure. I was picture Imran leaning forward in this chair to try to see this. This is from the CBOE, came out yesterday. This is cross-asset volatility. And when we did the March options expiration, we were talking about how, look, back then it was semi-chip stocks are ripping, everything's feeling good, the focus is on the NVIDIA GTC event. And what happened with that GTC event is that zapped upside call skews, right? Call implied vol came down, the stock up vol up regime kind of got tagged there, and it really flattened out. And we just hung out for the first 2 weeks of April, and now these geopolitical rate risks, et cetera, are increasing. So here we have in yellow is gold. Gold was making a really impressive move. Still doing all right now. You got obviously equity vol picking up. You got oil vol picking up. You got rate vol picking up. You got credit vol. It's all starting to synchronize and move higher. And so, this is a backdrop where things tend to break a little bit. Along those lines, we saw the largest ever VIX volume on Friday. I don't know if it beat it yesterday. I haven't had a chance to check that. But what was interesting is VIX call open interest didn't increase that much. So there's a lot of volume taking place, a lot of moves changing hands, a lot of rolling, I think, in this period. But this was the final chart before I get your 2 cents here, Imran. This number here, this is the longest number of days without a 2% drawdown. We still have not had a 2% drawdown. The last 2 days were about 1.5%. So now we're well over 400 days without a 2% move down. Obviously, there's only 2 other times in history that are greater than this. One is Volmageddon. That's what happened here in February 2018. And then the other one was about 3-4 months prior to the start of the GFC. And so, those 2 events obviously aren't are memorable drawdowns historically, but we've been in this regime of incredibly low volatility, right? Do you have an opinion, or sort of, if you're going to categorize why volatility was so muted over the last 6 months, how do you frame that yourself? What do you think led to this period of impressively low volatility?
Well, I think to some extent, vol sellers were being rewarded, right? And AUMs were growing. So we had all these ETFs that were selling super short dated optionality, growing in AUM. So that just basically brings more supply. So when a trade works for a long time, similar sort of story happened with Volmageddon in the run up to Volmageddon, right? When the AUMs of XIV went through the roof, there's just more and more vols being sold, and it becomes self-fulfilling to an extent until there is something exogenous to break us out of that regime, right? So that's kind of what's happening now. Like the threat of World War III is a big enough threat to break us out of that low vol regime. And at the same time, we've had yields becoming somewhat unanchored and rate volatility coming back with a vengeance. And those two things have been enough to kind of drive us away from what was a pocket of the street being supplied in gamma constantly. I think the numbers that Goldman's and BofA were putting out were $6 to $7 billion of gamma per 1% move in S&P was what the street had up there at 52.50 or whatever it was. And down here, they've got nothing. Like they've got zero gamma, if not slightly short. So that in itself means the market's less supported. And then the final thing that's getting people a bit, because, you know, we all know as discretionary traders who've been doing it for a long time, we all know that geopolitics is a massive fade, right? Assuming we don't go into World War III and the whole planet gets wiped out, which no one wants, right? Any geopolitical stress that is leading to de-risking in markets is a fade on a 3, 6, 12-month time horizon. Okay.
Yeah.
The problem is, it's not just discretionary money that's in the market. There's systematic money in the market that is vol control, risk parity, vol targeting, and all that is de-risking, right? So we're breaking through triggers for the CTAs on the short-term timeframes where we've gone through them now. I think they're around 50, 70, 50, 90. We've now got a medium-term. We've got a more medium-term trigger a little bit below the market still. But if these triggers are, you know, if we go through those support levels, you've got tens of billions of dollars of S&P needing to be sold. And there's not really a marginal buyer. When buybacks are in blackout, when there's no long gamma positioning to take that slack, there's no buyer. So you have an air pocket in the market where I don't really know where we find the lows, but the rebound from that air pocket will be violent, but it's just very hard to call the end of that. And I don't quite think we're there yet, given the precarious situation we're in with Israel imminently going to retaliate to Iran. And then we don't know what the hell Iran's next play is, basically, right? So I'd say whilst the uncertainty lingers, it's going to be very hard for this market to just rally straight back to the highs, I think.
Yeah, you very succinctly framed all that. And the way that we're thinking about it is, you know, we had this trend channel, you can call it. It's this move straight up to 5,200. And if we consolidate under 5,200, I think down to 5,000, kind of to your point a little bit, is you start to chip away at that support, the positive gamma support. You want to call it CTA support. To your point earlier about put sellers and vol sellers just writ large in there. So you have dealers with positive gamma, arguably positive Vegas stance, and they could provide liquidity. I don't know if you've ever read any of Chris Cole's papers and Artemis, and I've been going back through those, and he was talking about the idea that liquidity was an illusion, and it was more from a central bank perspective. That really struck me when you start to talk about how this market is supported with flows offsetting from the systematic call overriding, CTAs, all of the kind of financial engineering that's involved with today's markets, right? And I think when you break 5,000, then you start to see those flows go from supportive / neutral to possibly working against the market. And that's where you start to see realized vol really start to increase a bit. And to your point, there's that air pocket down beneath. And I think that, you know, that's some of the risk. Now in the short term, we have, and I want to ask you quickly about this. Let me pause first. So many ideas that off of what you just said. This is where Ukraine and Russia, the conflict started in 2022, right? The VIX made a high in late January of 2022. It did not make an intraday high larger than that when that Russia-Ukraine conflict kicked off. It was rates that really drove the market lower back in 2022. So there's this really fascinating parallel now of the geopolitical situation in the Middle East with rates going up now at the same time, right? And, you know, you have Biden out there saying, hey, we're going to get a rate cut. I don't think war is good for inflation. I think that would be a general stance that most people would appreciate. But the fact of the matter is, in the very short-term time frame, and I want to get your opinion on this quickly, we have VIX expiration tomorrow. And now that we have the VIX up at 17, 18, 19, I thought that some of the clearing of those flows related to OPEX, VIX expiration would help to support equities. Now, the geopolitical situation increased yesterday with the imminent strike, so that certainly put a lean back down on the market. But do you think that there is this window where if we get a little pause in the geopolitical escalation, that these OPEX VIX flows can help to sort of boost markets short term?
Yeah, I'm not so sure now that the VIX has popped up to these levels, right? I think if the VIX was near the lows at 14, then I think you get the charm effect. Like, so structurally, you always have a load of call buying on the VIX, right? So the charm impact of that call buying is that the VIX futures that are bought against those calls need to be dumped back onto the street as the premium decays away, right? So when the VIX doesn't ever go up and that the call premium just bleeds, then the supply of those VIX futures essentially is a bid to S&P, and it holds up the S&P. But if you've blasted through a load of calls, which I think we kind of have now, right? Then that charm effect is not as blatantly a big sell, right? It might actually be that some of those calls are actually charming, like more positive, right? So I don't think the charm effect is quite as big here, and therefore I don't think it's a given that the VIX expiry is a supportive factor.
Yeah, and now what about options expiration? Just as we approach on Friday, I mean, the put values compared to just a week ago, put values have certainly elevated quite a bit. There's a lot more volatility premium, I would think, in the market based on some measures. Do we think that those could be supportive flows, or do you think that those could be supportive flows if you back out, or does that fall in the same bucket as the VIX effect that you just mentioned?
Yeah, no, I think that maybe is a bit more supportive, given that we've had this big bid to skew, this big bid to vol. You would have thought there are a fair amount of end users who have bought puts, and those puts are decaying. And as those puts decay, there will be a buyback of futures associated with that, right? But ultimately, like in terms of the numbers, from what I saw from the Goldman's model, the Bank of America model, they're estimating like going from 6 billion, 7 billion long gamma to about -1 or 2 if we sell off down to 4,800. So I don't know that the position is that massive now, right? That the charm flows are going to be such a big factor. Like, I think the marginal supply and demand of futures and stocks that comes from just people trading around and de-risking, or the CTA selling, I think that might now be bigger than what the marginal impact is of the time decay of those super short dated options now, basically. So I'm not sure you tell me if you disagree, right? But I'm not sure we're being driven by those flows into Friday. I think we're kind of at the mercy of the geopolitics right now.
Yeah, and I think that's the hard part, is that it is such a day-to-day thing right now that Israel said a response is imminent, and so we're all waiting on that, right? It's not like the situation before where it's like they're crafting their response, we think it's going to be okay, we're not really sure, it's some time in the future that we can't quite put our finger on. It's not like we got to worry about the situation escalating in the next hour or two, right? And so the size of options expiration here across the indices you can see here, and what's interesting is that there's a balance now between calls and puts in terms of the delta size that's set to expire. We've not seen this much put size expiring, even though it's not all that massive. This is June expiration. The quarterly, it's much bigger. So to your point, these flows are not as large as certainly a quarterly expiration. I do think they're supportive. I do think that if the S&P holds above 5,000 and there's any kind of even just a little bit of a can kick to next week or something, then we could have a pretty decent rally back, up towards 5,200. But those are the short-term effects of, I think, the market. The vol of all will come down very sharply if there's any kind of little bid now, and vol coming down. Now, that being said, market's having a very hard time getting any traction today. Vol is just not retreating at all, because I think what's happening is, and this is kind of an interesting thing that I wanted to bring up, you have these situations where you can usually hedge events with zero DTE flows, right? You can hedge the CPI, you can hedge FOMC, but you can't hedge this geopolitical situation with zero DTEs, right? You need to own Vega or volatility for your portfolio in this situation. Related to that, historically what happens in these events, right, is you want to own treasuries, right? Certainly pre-2022, you'd want to own bonds. So this is the 60-40 portfolio. And so, the thought process is that when we started to raise rates, the 60-40 portfolio model broke, right? Because bonds didn't offer any kind of a hedge. Do you think that now bonds are a decent hedge in this situation? Because obviously, typically people will move to treasuries if there's a lot of geopolitical uncertainty, right? You want to go to the safest place that you can. In an equity drawdown scenario, do you think bonds are likely to respond because of the fact that inflation is going up and people are maybe projecting higher yields now? So do you think, question one, bonds would respond in the same way? And are they the safe haven in this scenario?
I don't think that. I think the evidence is telling us the contrary, right? I think the evidence is showing us that bonds are really struggling to catch any kind of bid, even as even when we're going into a weekend, we're expecting a strike from Iran, right? Bonds could barely rally, right? And
Yes.
and then the next day they sold off hard. So I think bonds are no longer the safe haven that they used to be, right? Because the inflation story, whatever it is, that the market has decided they're not. So the market is looking to things like gold. Bitcoin even had a moment. It wasn't this weekend, but like there was a moment when the geopolitics reared its head originally, and Bitcoin was up like 4 or 5%. And so there's other things people are using. Like if I really wanted a geopolitical hedge, I think oil's trade. I don't really understand why oil's not.
I don't
trading.
understand it either. I was hoping you could answer that question.
No, I'm struggling to understand it, like why oil's not spiking anymore. But the truth is, if it really did get that bad, if it got a lot worse, you would have thought owning upside in oil is a better geopolitical hedge than owning treasuries, right?
Yes.
So because the vol, you look at the vol in oil, it's actually percentile wise, it's only in the 30th percentile, whereas you've got equities in the 60, 70. You've got gold and silver at the highs on, let's say, on a 2-year look back or whatever, right? So oil upside is not anywhere near as expensive. If I had told you a month ago what the hell was going to go down with Israel and Iran,
yes,
you would have said oil's at 100, oil vol's at 50, mate. It's like 30 or something, right? If that, and that is that for me, that feels like a misprice.
This is what it did into the Russia-Ukraine situation. Obviously, I don't know much of oil, so I don't want to start opening my mouth about things. But I think the Middle East is as big of a producer of oil as Russia, or maybe not gas and blah blah blah. But I think most people listening to this right now would agree that maybe there's a little bit of a head scratcher in some opinions. So what I think is, and gold, to your point, is doing okay. There's the tax situation, which a lot of people are bringing up, that, hey, tax day was last week on Friday, and so there had to be some selling across assets generally. And I was favoring that was a mechanism to push the market lower. I didn't think that Israel would choose to respond. I mean, what do I know, right, about geopolitics? But to your point, you usually sell that geopolitical, risk. But this brings me back to this other interesting idea about volatility writ large. If you're in equities right now, and you're saying, okay, we have the catalyst of the geopolitical situation, which seems to only be getting worse, right? Certainly not bullish. You have the rates increasing, so we can't hedge that. So okay, you could buy oil maybe to hedge out the situation geopolitically, but that doesn't really handle your rate problem. And if anything, the geopolitical situation, if it moves oil up, which you would think at some point oil will respond, that only makes the inflation situation worse, which makes bonds an even worse hedge, which means that if you arguably are looking to hedge out your equity position, or you want to reduce your equity exposure, you can either sell it or you have to buy vol, right? That's the only, that's really the only out here, right? Because
yes and no. I mean, I would argue, because you look at it today, right? I mean, we're seeing a little bit of an offer come back on VIX. I mean, Spot, don't get me wrong, Spot hasn't exactly done it. Spot's unchanged on the day, but but I just think that you can put equity hedges in place that are not long vol bets, like put spread collars, basically, right? So you can buy put spreads and sell calls and have a hedge for another 10% down in S&P, and you're not a vol buyer, you're a vol seller. Those are the hedges that worked in 2022 when we had that
point,
right? So which is why I'm not convinced that vol has to go to 40 again. Do you know what I mean? Like, I think people have realized that they don't need to buy vol to protect using options as long as they're comfortable selling upside. and looking at where valuations got to, maybe they are comfortable selling upside now again, right?
Yeah, I mean, you could see like 2 weeks ago, you could see a lot of call selling in the Mag 7s, in NVIDIA, and some of those names, longer dated call selling. That look, the geopolitical situation, I think certainly was the push, as well as the rate situation, and who knew that was coming. But I think that maybe some of those valuations just got a little bit, rich, and people started to understand that. And I take your point on the fact that maybe people learned in 2022 that look, vol just didn't perform, and so you need to hedge a little bit differently. And to your point, then you have spreads and things like that, and so maybe that reduces some of the vol. But do you think that there is a decent amount of short volatility out there? I mean, one of the things that people would just talk about so much for last year was, put selling had, the best Sharp you could possibly achieve, right? As an example. And skews seemed very flat, or, maybe even tilted towards calls in a way that we hadn't seen in a long time.
But it's repriced quick. It has repriced quickly, though. It's back in the 80th percentile, right?
It did, yeah. And we didn't seem, and that didn't seem to generate much issue. Like the equity market seemed to digest that pretty well, I guess is what I'm trying to say, which I've also found interesting. So it's like gold, oil isn't moving up, and equity realized vol is not doing all that much. I mean, if we look at realized vol here in our index page, I believe 1 month vol is around 13. Oh, got to go down a little bit lower here. So here's realized volatility measures. We're pretty calm really right now. We got 1 month at 11.5, and 5 days at 13. So, you compare that to a VIX of, 18, 19. The VIX is certainly pricing in more volatility than the market's been realizing. That spread is pretty wide compared to what we've seen over the last several months.
Yeah, there's definitely risk premium in the curve now, but the problem with fading this type of stuff is if you get it wrong by a week, you could be so far offside if there is an air pocket that you got to find safe ways to do it, right? So I think VIX puts or VIX put spreads, things like that, because like VIX vol's gone ballistic as well. So like buying VIX puts doesn't look that cheap, but it really depends how fast vol resets. But if you buy yourself a month or two and you own VIX puts to like May or June, I think those probably still offer you half decent risk rewards. Like I bought some last Friday. I bought some VIX 15 puts to May, and they cost $0.50. So if VIX did go, if miraculously VIX went back to 13 by middle of May, those things make reasonable money. They make 3 or 4 times, right? Now it doesn't feel like VIX is going back to 13, but a lot can change in like 4 or 5 weeks, basically, right? So I feel that is probably for me the easiest, safest, cleanest way to short vol than messing about with any of like selling puts or selling naked risk. That is the safe way to do it, I think.
Yeah, and that makes sense. VVIX on the screen here, and that has a pretty decent pop relative to what we've seen in 2023. So checking some of the comments in here. Yeah, don't forget that the SPR is the lowest level since '84. I don't know when and if that gets covered at all. Strange days indeed. Yeah, and some comments on tax strain. So it's a very interesting situation here, and I think in the short term it is that headline risk. Now, the other side of this equation, I think, is we saw very low correlation. That was one of the interesting things here into the end of the year. Into the end of last month, where correlation was at real lows. You can see 1 month correlation here from the SIBO, 3 month correlation. Their same measurement or metric, shows us all time lows in that index. And now this correlation is moving up a little bit. Like everything else, it's high relative to where we've been over the last several months, but we're not still almost back in the context of where we've been over the last several years. Now. Previously, you've seen correlation go lower into earnings, and earnings is starting to pick up now. Banks are fairly mixed, I think, in earnings. But I viewed that the lower correlation here is an offset of some of the systematic flows we've been seeing, like call overriding, possibly even zero DTEs, et cetera, that really serve to suppress index volatility. And now correlation is popping because stocks across the board have gotten weaker due to the macro concerns of primarily, I think, geopolitics at this point, but you have to add that those rates in as well. What do you think about correlation kind of increasing? And is this the start of a more normalization here, or do you think that we run the risk of, like, we move into earnings, chip sector earnings are still great, and that we just levitate again, things go back to normal, or is there a little bit of a regime shift here?
Yeah, I don't think it's a big enough move to call it a regime shift. I think some of that move, or most of that move, is probably just by the fact that S&P sold off a couple of hundred points, and the fact that the skew in index tends to be steeper than the skew in singles, right? So what you essentially do is you go down a steeper skew, so you move to a higher implied vol on on index, sorry, and the stocks, they move down a flatter skew, so their vol doesn't pick up as much, and that's where you see a pickup in implied correlation, right? But it is unusual to see a pickup in implied correlation going into earnings, but because we're coming from such a low base, I look at 20 and it doesn't look like a high number, basically, right? If it was at 40 or 50, then you'd be like, oh wow, okay, that's a high number, and that's very surprising. But for it to, I think this is much more just a function of riding down a steeper index skew, the fact that we've had a 200-point sell-off, than anything actually really game-changing.
It's an interesting, excellent points as always. The thing that I'm thinking about, I'd like to get your feedback on it, is that we now have the situation where, let's say over the next 2 weeks, we don't know what's going to happen with the geopolitical situation. I think that it can cool off from the place it is, but it's probably not to be resolved. So let's say that we would likely have to carry some type of a little bit of a vol premium for the next several weeks on the back of the geopolitical issue. And then we're going to run into the FOMC, right, on May 1st, which is going to be one of the more interesting ones given the state of rates, right? And you have the kind of conflicting monetary fiscal policies with Biden commenting on, we're going to get a rate cut and stuff. So there's a lot of weird things shifting in that space, I think. And so, that's going to demand some vol premium. And yes, the election isn't tomorrow, but it's not that much farther before you're going to get vol supported just by the election effect, right? And so, do you see a window here for vol to really cool off over the summer, or is this the situation? Yeah, you think it'll do it? Okay,
I do. Yeah, I think you're going to.
And why is that?
Because I think there's just too much structural vol selling that is just itching to sell vol, right? So I think it's like the minute you get the geopolitics cloud clear, there'll be more appetite to sell vol. And when you get guidance from the Fed, if you get guidance from the Fed that actually inflation is this inflation spike is transitory, it's still doing what we want it to do. If you get, and you've already got that implicit, this pop in inflation that we're getting is not so violent that it's kind of in line with the projection. The Fed projections were for inflation to tick higher into year end, right? And yet they still kept their projections of 3 cuts. So they implicitly told us that even if inflation goes higher, we're still giving you 3 cuts, right? So they've kind of implicitly said in their last meeting that we are no longer targeting 2%. We're targeting between 2 and 3%, right? Which is why gold went ballistic to the upside. The reason why gold went nuts is because gold was the one market that cottoned on to the fact, Bitcoin had already done it, but gold was basically confirming that these guys are basically going looser than they should be. And that's what unanchored these commodities, right? Now, it might become self-fulfilling where all these commodities just go gangbusters and actually inflation overshoots way more than the Fed thought it would. And then they do have to actually do something on rates, right? So the market might test them. You know how like the bond vigilantes used to force the rates market and kind of make the Fed do what they wanted? It might be a case of commodities push inflation to a place where the Fed has to actually chain tack and they can't be as loose as they want to be in an election year, basically.
Imran, we talked before about every time we have one of these calls, something seems to move, and we're seeing a pretty good sell-off here in the spiders. I don't know if
I told you, did you sell your futures first?
Oh man! All right, down it goes again. Just to put this back in context, We have one level below 50-50. That would be the 50-25 area as a kind of interim support. But I do think under 5,000 that's where vol could really jump. Realized vol could really jump, and we're not realizing that much at this moment, in my view. The moves have been pretty tame. Let's see if anyone happens to mention what is going on out there. Quiet at the moment right now. Yeah, Powell's set to speak at 1:15, so I don't know if he said something, but down we are going.
Yeah, Powell is speaking. I think I'm seeing some stuff hit the tape. Recent data show lack of further progress on inflation. So Powell's basically speaking a little bit more hawkishly. Yeah.
So we can add that onto the mix. And so if you do want to head, oh my gosh, down it goes. All right, yeah. Powell talking is what Tech says. All right, thanks, Tech. So Powell's not supporting equities at the moment.
Don't worry. Give him a minute. Let Yellen get on the phone to him, and we'll see what happens.
That's what it seems to happen. Now, do you track China at all? I guess some of the questions is, do dollars start flowing elsewhere here? If you look at the Chinese market, it sold off obviously rather violently, over the last several years, and it seems to, despite or contrary to Western equity markets, it's really been kind of flushed out. Is there any reason that you, number one, if you're not ready to answer this question, just say move along. But do you think that there's any interest here where maybe China's taken some pain and U.S. markets have not? Is there any interest in anything else outside of the U.S. equity market?
Yeah, I mean, I wrote a piece in a bit of my morning piece this morning was talking about China and saying that hedge funds have been buyers of China by the looks of it for the last few couple of months. And so whilst we're seeing a de-risking across most of the space that has rallied, China being so underpositioned, so beaten up, isn't really seeing that. It's actually seeing mutual funds taking down their underweights, hedge funds buying it. You've had a better macro picture forming. You've had better earnings coming. So the rate of change of everything in China seems to be heading in the right sort of direction. Plus, you've got policy support. It's not been a bazooka, but there is still policy support rather than restriction. So yeah, it makes sense that people are allocating a little bit into China. I've got some China calls to June, which haven't really done anything yet. So I might have to roll them. But yeah, I don't think owning some China is a bad idea given what's going on. People are going to have to want to park their cash somewhere, and people see valuations in China as very beaten up still, and there is potentially still a story there where you could make some money over the next 12 to 24 months allocating into China.
Well, glad I got that question. I didn't realize you wrote that this morning. So I've thought that'd be interesting when you just. They seem to be an arm's length distance from the conflict, and I know many of you in the geopolitical arena here are probably throwing things at your screen as I say that, but it doesn't seem quite as involved as maybe some of those Western markets. So I think that's interesting. Apparently, Fed is saying if higher inflation persists, they can maintain the current rate. So, you don't have the situation where we're going to raise rates. It's just all these cuts, which seem strange to be priced in anyways. People are maybe going to erase all cuts now. But the market digested that very well, which is also a bit curious to me. One of the things that was highlighted recently was on the left here. This was last week after the CPI reading. Again, I understand this is a little bit hard to read, but we saw one of the biggest move in 5-year rates, and I'm assuming it was equivalent in some of the other tenors as well. One of the biggest single-day changes in 5-year rates, and that didn't seem to really spark equity vol or shift really valuations whatsoever. And I think one of the things that seems challenging about this market to me is that, and it feels like past periods in history. I can remember in 2006, when people were buying all these houses, and everyone's like, "This is crazy! Like this makes no sense. Like this is a setup." And it just goes on for a lot longer, right? It's like you can see things shifting under the hood, and you don't get the confirmation of like a real violent equity sell-off, right? Or an equity reaction to what seems to be obvious. And in this case, given the rates, given the geopolitical situation, it does. It just feels like the equity vol is responding pretty well, I guess is what my point is.
Yeah, what you're basically saying is the market is being quite resilient versus everything that's being thrown at it. That's what you're saying, right?
Yes, that's much more eloquent. Thank you.
Yeah, I couldn't agree more. I couldn't agree more. I think it is being very resilient, and actually, that makes me more bullish, right? That makes me think, yeah.
In the short term, so you're based out of London, and so I'm curious your take on this. But a lot of us here, and I'm in this camp, feel that and I don't want to upset anyone, but like I do believe that the political, monetary fiscal apparatus, let's just say here, is supportive of the incumbent into the election, let's just say. And so you have the situation now where we have the November elections, and you would think that they're going to throw whatever they can to support the equity market here in the States, because it is such a barometer for how well, America is doing, so to speak. Do you have that same opinion that there is, a reason to think that markets are going to be more resilient now until the elections here in the US, or is not something that
Yeah, no, look, I've got a very close friend who I worked with at Citi who does a lot of cycle analysis. And the election cycle is quite a important cycle as well in his analysis. And yeah, I mean, it's going to be very surprising if we don't have a rally year on an election year, right? It's quite rare. And so he's very much still calling for dips to be bought in this market. The fact that the market is trading so resiliently with what is being thrown at it makes me think, yes, it probably is a dip buying market still. And you don't even have to buy it in a risky way, right? If we look big picture and zoom out, and we say November expiry options, which contain the election, those upside calls, like up at, I don't know, 5,800 on the S&P, they're probably not on a very expensive vol still, right? Because like as we've sold off, the skew has gone steeper anyway. So whilst puts might have gone ballistic, calls haven't gone ballistic, right? So I don't know if you can see that on your new dashboard. Like, what do the 58 Novembers look like in terms of vol?
Zoom out here a little bit.
Put you on the spot now. Show everyone how to use this tool. And you got to get the strikes up to 5,800.
Yeah.
There you go.
There's some 5,800s.
And then we go.
I got to expand. Bring more data in here. So you could see what'll be interesting here is you could see it's about 12 and a half.
That is not a high. That is not a high number. That is not a high number, right? So if you want to play the scenario that we rally into an election year, and you want leverage to that scenario, and you want protection to the downside that you're not going to blow yourself up, you just buy some of those calls on the 12 vol. Simple.
Yeah. It's pretty interesting. The statistical mode here, tongue twister. You can see there. You can see that they bump a little bit due to the election, right? Because the October obviously doesn't price the election, but November
that's the reason to own them, because they're going to hold that. They're going to hold that vol premium into the election. So like, as we rally, because what normally happens is when we rally, vol comes off. So as we rally, if you own September or October vol, that'll get offered because it doesn't contain the event. If you hold the November or the December options, they're going to hold a vol premium, and that vol is going to behave better, basically. So that's the reason to own them.
Yeah, very, very good points there. And then here's the term structure, longer dated. Obviously, with the lift in vol this week, longer dated implied vol is at the money is roughly 15, which that doesn't even price in or barely prices in 1% daily moves in the S&P. But this is obviously much higher than we've seen, that shaded cone being the range 10th to 90th percentile over the last 90 days. And so term structure is elevated, but you look out in time here, it's really not, I don't know, it's not that crazy. But this is the election bump. You can see it right here. Another way just to look at that. And that bump is going to persist as we go forward. So through your lens, though, we'll get a vol dip for sure. Or I shouldn't say nothing is for sure, but you're seeing a vol dip sometime into the summer, I guess, and then we'll kind of ramp back up into the election.
Yeah, I think so. I think whatever this episode is that's going on right now, when this vol spike's over, we'll get our usual kind of sell off into summer for vol, and then into the election that there'll be a bit more excitement.
Nice, George. The tool is fantastic. Appreciate that. Lowell, hey Lowell. He asked about dollar yen. You got any views on that? He mentions that if they intervene to prop up their currency, i.e., sell treasuries. Don't know if you cover the FX space at all there, Imran.
Yeah, I mean, it just keeps on rallying, right? Because US rates are moving up faster than Japan rates, right? So whilst they did shift policy, they did it in a way where, yes, they stopped being negative rates, but they said that they were going to intervene in the bond market as and when they needed to still. So it's kind of it's like a managed ascent in yields versus what's going on in the US with inflation prints coming hotter. That's just becoming a bit unanchored, right? So it's all moving on rate differentials right now. So dollar's catching a bid because yields in Japan aren't keeping pace, and then yields in Europe have actually been going down. So euro dollar's got smashed, dollar yen's rallying. Now there's a threat of intervention at like 155 or something like that on dollar yen, which is why dollar yen put skew is bid, because people are scared that they're going to come and smash it 5 big figures. So that skew is holding quite well bid, but no one really knows the level that they're going to do that at, basically, right? So for me, that's a very idiosyncratic, very specific to what the Ministry of Finance do in terms of intervention, that trade. And so you can't, unless you have some real edge in knowing that timing, I don't really know what you do there, right?
I'm glad you feel that question, Imran, because I am lost on the FX front. Checking gold as a measure.
That's why my piece is called Macro Options Daily, right? We look at macro options.
I have enough trying to wrangle the U.S. options market here. All right, so as we start to move into the end of the session here, if we do get a pause in the geopolitics and the market does start to rally, what are the stocks or sectors that you think we should eyeball if indeed we do move higher? Because we're gonna move higher with the specter of higher rates, right? I think everyone's resetting their expectations to rates being a little bit better supported. And what was interesting is we spent so much time talking about the NVIDIA event, the GTC event on 318, and how that would zap call skews and lead to consolidation. I did think we would get a little bit more initial weakness out of the semis, but they've held up really pretty well in the face of all this, as you can see. NVIDIA is down 10% from that weird intraday high it had near 1,000. And so, there's been some resiliency in this space. If vol starts to get sold, I mean, is it just earnings dependent that this sector automatically starts leading us back higher? Or there are other sectors or more interesting places to look at now if the market starts to bounce?
I mean, I'd almost be tempted to just go for the S&P and not try and be clever on the sectors, because you might get a corrective phase in the semis, but then energy might take up the slack and rally, basically, right? Like what we've seen recently, right? Energy was doing really well. Tech wasn't so much. Tech was flatlining, but energy was carrying the market higher. So I just think that, there's rotation within the market, but overall, I think the market can go higher, basically, right? So I would probably just do that. I would probably just use broad market, either NASDAQ or S&P upside, to express a bullish view rather than trying to pick the sectors. I mean, if I had to, commodity sectors potentially could really get motoring higher, like the metals, for example, might have a bit of a catch up in them.
Yeah.
Because they've been, they've been, but even then, if you bring XME up there, right, like how much has that already started to rally? Quite a bit.
Yeah.
Right.
It's holding up pretty well. And the energy sector is an enigma right now in terms of its reactions to me. IWM is the one that I think is also very interesting, because it threatened to break out mid-March, end of March, and now you would think that, I mean, hopes for an IWM small cap rally are going to be dashed with higher rates. which makes me also wonder if we do start to get a major sell-off, is this where you want to focus more than S&P?
Maybe. I mean, the price action is certainly looking a bit stinky, right?
Yeah.
I mean, this is something we've talked about. I mean, we've been doing these calls for years now, and like we often say, sell the stuff that trades poorly and own the stuff that trades well. And this is another example of it trading poorly, right?
Yeah, and it doesn't have that same narrative. I actually, tech seems to be holding up fairly well. I mean, the other interesting thing here is the Mag 7s. They got so beat up, right, into mid-March that, people are saying, well, it's just Mag 4s now, right? And we started cutting all the names out of the Mags. And then it was like, look, the leading sector is just chip stocks. If there are higher rates, I think that some of these names could be, maybe where you want to be in terms of safe haven equities, so to speak. And maybe not specifically Apple, but you look at some of the other larger tech names.
Keep it on Apple. I want to ask you about Apple.
Yeah,
right?
Please.
So there was news out on Apple. It started ripping at the end of last week. You saw that big pop. It's faded it now, but the reason for that pop was because they talked about overhauling all their iMacs with a load of AI features, basically, right?
Yeah.
And they've got this massive conference coming up in early June. And they've got their earnings obviously in May. So whilst their earnings might be a disappointment or whatever on the back of what's been going on in China, demand for Apple or whatever, I kind of think Apple's an opportunity because it's been left behind. So you had all these Mag 7s flying on the AI story. Apple didn't participate. And then Apple finally realized that they need to scrap the EV initiative and go to AI. And now they're going to unveil a load of stuff in June on AI and a potential tie-up with Google and stuff like that. So I actually think there might be a really good upside play in Apple into June, July for that big conference that they've got going on. And what I'd like to see on the vol dashboard is if that's being priced at all, right? Is there anything in June, July upside in Apple that is showing an event risk there, basically?
Yeah, I mean, if you look at if you look here, you can see that term structure lifts up there. In a few weeks, basically, is what that's.
That's the earnings. That's the earnings.
You're not seeing the longer dated thing. Sorry, I got to zoom out a little bit more.
So June, July.
Yeah, a little bit of a kink there, maybe.
Small, but that's small, right?
Yeah. And it could also increase after earnings. I mean, you could maybe people say, well, everyone wait for earnings and then kind of reprice that going forward. But it's held this support in this 170 area pretty well, despite broader market weakness. And obviously this is a pretty big fade, but this has been an area where there seems to be more activity, right? A little bit of buyers. And they had, Warren Buffett dumped. They've had the Department of Justice issues. I think people do feel like they're a little lost on AM, the card. And so in a weird way, like the China situation, it's like, well, the book was already thrown at this, so there's just less relative downside there. So, to your point, it could be a pretty interesting long play. And this seems to be an area in the past, right, where, people are finding a little bit of value there if you zoom back over the past years.
Yeah.
And the same, obviously Google's had some little bit, they had that trip and then they said, oh, AI, and we got some new chips and things like that. You also have the other interesting, dynamic here where, and I know this is always talked about in the All In podcast, but the idea that, NVIDIA was the leader and now everybody knows the products they're building. And so now Meta's building their own chips and all these other people are building their own chips and Intel's getting a bunch of money to go build their chip factory. And so that, there's a lot to erode or start to attack that, NVIDIA base, right? And so kind of to the other point, I don't know that the dynamics of king, godlike NVIDIA into March can just get stoked back that easily. It almost makes you feel like there should be more of a broader, rally as opposed to something that was so well-defined over March. So, if we do bounce to your original point, okay, maybe Apple and some of these other, but just broader Q exposure, broader spider exposure, probably stay away from the IWMs. I'm sure everybody listening here is instead just going to go and short VXX as much as they can instead, right? Please don't do that as a joke.
Fixed puts.
Fixed puts, as you say. And it's oddly very resilient. And then I think the last thing, as it holds a special spot in my heart, is gold. It seems like this is maybe finally the moment here. I don't know if this is a breaking off of the idea of the inflation, cat is out of the bag, and all the other sort of political links you can make to that, failed policies and whatnot. But is there more to go here? Is this a place that you think is going to be resilient in I know we just talked about it before, but is there resiliency here going forward, or do you think this is going to be another upsetting mean reversion that dashes people's hopes of?
It's a tricky one, man. Like, I was impressed at how violent that move has been. Yeah. And the fact that it's completely decoupled from real rates, because real rates used to be a big factor for where gold goes. And so you've had dollar rallying, you've had real rates going higher. Both of these things are typically bad for gold, and gold has gone ballistic, right?
Yeah.
So it is. There's definitely a structural thing going on here. I think it's got something to do with the kind of unsustainable fiscal deficits that the US are running, and kind of what that means longer term for like fiat currency debasement, basically, right? And that's the story that I think it's latching onto. It is that one of the big reasons why you want to own things like Bitcoin and gold, for that fiat debasement protection. And whilst Bitcoin's been giving it to you in spades since the sort of late last year, you haven't had any of it from gold until the last sort of month or so, right? So suddenly people have remembered gold for whatever reason, and then the geopolitics also helps. So I think if the geopolitics doesn't blow up, then you'll probably get a correction. But I think you'll find support at old highs, and you'll find a base there, and you'll continue trending up, basically.
Yeah, and on that point, which I think we'll close on this kind of final, little bit more of a macro idea, is that if you continue to have this sustained inflation, and some of the reasons that gold is going higher, I mean, does that just keep the bid into assets in general, equities or whatever else it may be, right? And if you listen again to some of those Chris Cole podcasts and some of the things I've seen on Twitter recently, you go, well, you start to worry about right tail risk as much as left tail risk in that scenario, because if you have debasement, et cetera, then the chase is on for assets. So is that another thing you think about now, or is that the possibility that farther on?
Yeah, no, I think so. I definitely, like I said, I don't think we've seen the top in markets. And I think the big reason for that is that money's being debased, right? And that's not about to stop, right? So I think that it's going to be Bitcoin above 100K at some point, gold's going to hit 3,000 at some point, and S&P is going to go through 6,000 at some point. It's just a question of when, right? I think that trend is still in place. I think it's because they keep on debasing money, and that's all they can do. And so I don't see the point in fighting that, basically.
And I think that one of the things that most people here in the States would agree is that both Biden and Trump, it seems like one of those two will be elected. Both of those, presidents are not like the political environment here does not support austerity. So I don't think that changes the inflation picture, maybe regardless of who becomes president here. So that trend may persist on into the future. All right. Well, that's going to wrap us up here, Imran, as we hit the top of the hour. I want to thank you so much for taking your time here. And you gave us a very clear market. So gold 3,000, S&P 6,000, 2 months from now. That's what your time frame is?
I don't know about 2 months, but probably not 2 months.
All right, sometime out in the future. I would just wrap it up by saying, like, as we hold this 5,000 level, particularly get over the next couple of days, and there's any kind of cooling in that geopolitical situation, I think we kind of bounce pretty sharply of that 5,200 area and into May 1st is what I'm thinking. And then we got to digest the Fed and see what comes out of that as sort of path number 2. I do think that 5,000 is pretty good support at this point, and that OPEX should be a little bit of a tailwind. So hopefully, if we could just step back a little bit from the geopolitical escalation, then I think that picks up. But if we do break 5,000, then if we do break 5,000, then I think we're going to start realizing a lot more volatility. And so that's the way that I see things. Imran, thank you very much for your time today. Where can people find you, get more of your great content?
Thanks, man. Yeah, it's always a pleasure catching up with you for these monthly OPEX calls. So I'm options_insight on X. We give you little snippets about what we're seeing in our research and what's going on in vol cross asset. I've also got a crypto options podcast for those of you who have the ability to trade crypto options and are interested in that stuff. I'm quite active in crypto markets right now, especially with what's been going on. So yeah, feel free to come and then we've also got the website options-insight.com where you can see exactly what we do.
Awesome. Thanks so much for that. You can reach us at SpotGamma.com. Come check out our new vol dashboard. We showed some of that here today, and you can also see me at SpotGamma on Twitter. So thanks so much, and we will be seeing you all